Welcome to the Become Sensible podcast, where we discuss practical accounting, finance, and tax for everyday business. I'm your host, Fiona, and I'm here to show you that no matter what your business financial situation is, you can change it. Good morning and welcome back to Become Sensible. Today we talk about a very important topic as an entrepreneur or business owner. So like you scale the company, you grow the company, and at some certain point you need outside investors, a bank loan or credit line. And you think like with $1.6 million in revenue or $2 million in revenue, you can come in and walking into the bank and borrow a credit line of like $300,000. And then you got rejected. Why? The reason is because as an entrepreneur, a business owner, you think about the language of sales, which is the revenue that you generated. But with the bank, they actually talk about the language of credible and risk management. So that is why to get that 1.6 or $5 million revenue goals, you need to start speak the language of entrepreneur and start to speak the language of credible. Today, I'm giving you the blueprint how to make your business truly bankable. It means that you can borrow the money, you have an outside investor. Number one, you think about it's like people apply for a job, their resume talk about the history of what they achieve, their track records. So the same way in your business, if you go to the bank, your profit and loss, your balances are your resume. If you have like miscellaneous expense, you have a mix between personal and business expense. In the office equipment, you aren't just messy, but you are unbankable because it's make the bank like feel a high risk into your profile. So let's talk about like how actually look at into your business resume, your financial report in the way that the bank is thinking. Number one, now we talk a little bit like technical, and I know it's maybe make you feel like overwhelmed with like technical information, but of course financial and accounting cannot like talk technical at all. So when the bank actually look at your financial report like Capital One Bank, United Banks, or whatever the bank that you are applied for, they need to look at your profit and loss, and they need to do stress testing. So there's three specific things. Number one, revenue concentration. If your 60% of your income come from one client, you has a certain high risk bet. But of course, if you government contractor and your prime contractor is not group or Lockheed, this is giant company. So there's certain thing that they will allocate in terms of risk of the revenue compared to like other industry. So it also depends a lot in your industry too. But the more you diversify your source of income, the less likely the risk of your revenue is. Number two, gross profit margin stability. If your margin is 40% 1 month, but then the other 1 month is like 12%, it tells the bank that is your business is not like a very stable. That is why many of the bank they will look at profit and loss month by month for the 12 months so that they can see like the trend happening in your business. If they see that okay, this is change, but everything is stable around 40%, around 50%, whatever that number is, that make them see your business is like what that number is, that make them see your business is like predictable and less uncertain and less risky. Number three, whether your business is fast, it has muscle. So the bank don't want to see a huge lifestyle spend buried in travel and meals. If you reclassify those spend into owners, and then that would be like so much better than you get it into a lot like travel is spent. Make sure that this is very clearly categorized and make it in like the right way. The other thing is business owners always optimize for a tax purpose, which is you have a strategy, you pay for employee compensation benefits, you pay for a ton of many different things, so that it's optimized for your company in terms of tax and your own retirement, your own benefit. But of course, when you optimize for tax, because tax is based on net profits. So when you make this optimization for in terms of tax, in terms of bank loan, if the profits is very low, it also like make the bank a little bit like worry because the margin is very low, whether you actually have enough profits to actually pay for your principal of the loan and then also some of the interest on top of it too. So that is the other thing need to be considered, that always think about like two sides. If you actually think a lot about like scale and you need capital to scale the company, need to be thinking about the optimization in terms of tax strategy need to be in considerable too, because it's if you lost every single year $50,000 loss for the last 2 3 years every single year, then make your profile like a little bit like high risky for the bank, because they worry that you don't have the net profits. Net profits, if in cash way, is the amount of cash you will be able to do take care of the mortgage and the principal payment for the bank. Number four is, I think, especially if you in the like government contractor, B2B consultant, and your contract with the company or with prior contract, it has a long period of time, maybe like from 2025 to 2030. It has multiple year of contract, and the bank always want to make sure that okay, you not just looking good in 2025 and 2026 in terms of revenue potential, the money coming in, compared to 2027, because it's suddenly like, oh, the contract is end by the end of 2026. Now you have a huge gap of revenue, and whether you will be able to get the contract renewed, that put the bank in the high risk situation. If you can't, your contract expire 50% of it and you can't renew, and the speed to get new contract coming in is not fast enough. It's put very high risk, and they worry that you will not be able to pay back the bank loan at all. So that is why I think there's a couple pillars or strategy that can help you to make sure that you are bankable. Is number one is look at your debt service coverage ratio. Normally, like every dollars that you owe from the bank, how many dollar profits do you have? It's meaning that if you less than a $1.25, you are in danger zone. So, for example, if you owe the bank dollars, you need to have $1.25. It's mean like extra 25 cents to make sure that okay, your debt is not you not too much high leverage, because debt can eat all of your net profits and become negative a loss in terms of business, and that will put you in the cycle that you will not make enough the cash to recover or to hedge over the situation, that economy downturn, a change, high risk situation, which is unpredictable in the economy all the time. So make sure that if you owe $1, you have a $1.25 in the net profits, so that it can cover for the bank loan. Number two is ABAC strategy. If there is the personal spend, need to like recategorize to owner distribution, owner personal expense. That's who's sitting on the balance sheet, not on the profit and loss at all. And then you need to have a 12 months rolling forecast, which is, I think I have an episode like way back in 2024. There's an episode is called What is Rolling Budgeting and Forecasting. This is very helpful if you need to listen to that episode, but it will help you to see what is your revenue assumption. Always in your forecast, you need to know what is this key driver in terms of your revenue and in terms of your spend. And once you make sure that you have the right assumption, then your forecast to the banker is look okay, is built on a very strong foundation. And that is just like they feel okay, there's less likely of risky in the situation that you will become insolvent. When you think about the bank think about risk. When you think about they think okay, it's you doing well in history, but they need to think about the risk of your profile. When you think about your business, normally business owner normally think about the possibility, about the probability to win and the potential. But when you think as the banker, you would think about what is the risk of this company, this profile. So a regular person who do bookkeeping, they wouldn't think all of these things at all. So you need to make sure that your finance or accounting team actually understand the language of the banker. And whatever it is, you need to have your finance team, especially if you scale up. Shouldn't have just only a bookkeeper. Someone will need to sitting down, go through your transaction and tell you where's the thing that you need to consider if you plan to apply for the loan. And this happened. We have a 4 or 5 client is on the process to apply for a loan. And I need to just sit down with them. Okay, so this is your tax situation. This is your financial situation. And this is what is your revenue forecast look like? What is the thing that we need to be and make sure that this is correct? But it's also less risky to the bank so that they feel like, okay, there is a certain thing that is going on well with your business. So if you are planning to scale your company and you need capital, don't wait until you need to fish the money, fish the book to be able to apply to the loan. It's just very important that when you scale the company fast, you need to have a time actually sit down, go to these plan and this strategy and make sure that your financial report is matching. Of course, if there's something wrong, there's something need to change. That is the action plan that you need to make sure that you get to that point so that your business will be like a good profile to the banker. I think that's just all for the episode today. If you have any questions, let us know and we here and we can help you with so many things in terms of prepare for your company to apply for the bank loan scale of the company. And thank you so much for your time today. I'm looking forward to the next couple episodes. Bye bye.